Thank you, Evan. Thank you, Evan. Now, what are accounting and tax differences in the context of legal political environment in international trade? Okay, so despite some differences in regional or municipal laws within a country, overriding national laws link a whole country together. So different countries adhere to various treaties. That's truly correct because we have what we call sovereign entity. When we said sovereign entity, we have our own laws and political systems. Basically, these laws dictate us, the businesses rather, and how they can exist, how they can be organized, their tax liabilities, the minimum wages they must pay to employees, and how much they may cooperate with competitors, and how they must price their goods and services. Now, companies that do business internationally are subject to the laws of each country in which they operate. So, when laws differ greatly from those at home, a firm may encounter substantial operating problems abroad. And differences in taxation practices from country to country exert a huge influence on both the strategies and tactics of multinationals. Now, let's take a look at the gap between accounting and taxation. Flash at the screen is the summarized one. So, in accounting, the basis is accrual basis, and in tax, it's principally cash basis. So accrual basis, it means that you will record revenue when it is earned, not when it is paid. But on tax, you will record it when it is paid or when it is received. So equations under accounting is revenue minus expenses will get accounting profit. That in tax, when we deduct the taxable income to tax deductions, we will get the taxable profit. Okay? So accounting profit does not equate taxable profit. And there could be differences because of the difference rules that we can apply in both accounting and taxation. Now, let's talk about the significance of accounting and taxation. So basically, they have the same role, and that is to provide us the information for the financial statement so we can make better decisions. And it would also help us track income expenditures, ensure statutory compliance, provide us with our government and quantitative financial information, which could also again be used in deciding. Okay. Now, moreover, we also have to talk about the globalization and its effect on the movement of goods and services. So, as globalization increases, the movement of goods and services across political and cultural borders and the movement of financial resources across borders also increases. Okay. Now, borrowing and lending across borders is growing. Cross-border stock ownership is growing at an even faster pace as companies seek equity capital in foreign countries as well as in their home country. So there is a growing culture of equity ownership throughout the world as developing countries experience economic expansion and more developed countries seek to privatize many economic entities that were owned by the state. So these trends require accounting information that is useful as it crosses political, cultural, and geographic boundaries. So just as cultural, political, linguistic, and economic factors that differ from one country to another, let us try to check on the differences of taxes. So because accounting information can sometimes add to this difficulty. You get it? Now, no two countries on earth have exactly the same set of accounting rules to produce financial statements. And these differences were caused by good reasons, notably. First, the differing sources of external financing. Second, differing legal systems. Third, various political and economic ties. And fourth, the varying levels of inflation. Five, the varying levels of economic development, and sixth is the cultural differences. Now, there are four strong forces at work, however, to mitigate the effects of accounting diversity. And notable is the work of the International Accounting Standards Board. Oh, let me get back to that. Okay. International Accounting Standards Board is an independent international body, and it has put together a set of accounting standards known as the International Financial Reporting Standards here. Okay. This becomes widely accepted throughout the world as an alternative or sometimes even a substitute for a nation's own domestic accounting rules. Okay. The European Union, as of 2005, has mandated that all companies listed on a stock exchange uses IFRS. IFRS are becoming acceptable in many other countries throughout the world as well. And many accounting bodies throughout the world have publicly stated their intention to converge with IFRS in the near future. So talking about in the Philippines, do we really conform on the accounting standards? Just like here, flash on your screen, the International Financial Reporting Standards? Well, let's see. Absolutely yes. Okay, we conform our accounting standards to that of the IASB. The IASB, that stands for International Accounting Standards Board. Accounting standards in the Philippines are adopted from the International Financial Reporting Standards issued by the International Accounting Standards Board. And the IFRS is a set of accounting standards that are recognized by at least 120 countries, and that includes Philippines, of course, and it provides a guide on how particular types of transactions and other events should be reported in financial statements. And you'll be asking yourself, why do we use? Why do we incorporate such? The rationale for that, it's because the IFRS or the Philippine Financial Reporting Standards used to ensure consistency in recording, recognizing, and measuring transactions, financial in nature, which it allowed if we are going to follow it properly, we will surely stabilize and we will be transparent throughout the financial reporting process of the company. So these standards are not enforceable as compliance because it's voluntary. Okay. So does this mean that there is no modification in our accounting standards in the Philippines? No. Okay, that's no. The PFRS or version of the IFRS which has some minor modifications, and the Philippine accounting standards are issued by the PFRS Council, and it's formerly known as Accounting Standards Council under the oversight of the Board of Accountancy. Hence, the PFRS and the PAS or the Philippine Accounting Standards are our current set of general accepted accounting principle. Now, what is generally accepted accounting principle? This vary from country to country because we have different legal systems, we have different level of inflations, culture, degrees of sophistication, and the use of capital markets and economic ties with other countries, right? So entities registered with the Securities and Exchange Commission, like the corporations and the partnerships, they have to be registered in the SEC, and they are required to apply PFRS as their financial reporting framework. So the PAS, the Philippine Accounting Standards, just to give you a hands up, it corresponds to the adopted international accounting standards, while the PFRS, the Philippine Financial Reporting Standards, it corresponds to the adopted International Financial Reporting Standards. So previously, standards issued by the ASC or the Accounting Standards Council were designated as statement of financial accounting standards. Okay. If you want to check on it, just go to Philippine Accounting Standards, and it was perfectly shared by Attorney Dennis B. Funa. Okay, now, in addition to accounting diversity problem, is there any issue aside from that? Yes, of course. There are several other accounting issues multinational organizations must face, and these are the use of different currencies, and the different tax laws and rates in different countries. Multinationals must aggregate the financial statements of their various subsidiaries throughout the world to produce a single consolidated set of financial statements, including issues arising from the use of different currencies and such. Multinationals must also deal with the different tax laws and rates in different countries and often attempt to minimize their worldwide tax liability. So this situation becomes even more complex when one subsidiary of a company buys or sells a product or service to another subsidiary of the same company in a different tax jurisdiction. Okay. So countries, we have our own legal mechanisms to ensure that we receive a fair portion of the tax revenue, perhaps. Diba? Now, let us go to the corresponding diversity in tax systems and rates. Okay. Just as multinationals are forced to cope with the staggering diversity in accounting customs and regulations, there's also a corresponding diversity in tax systems and rates in virtually every country on earth. A nation's tax policy is set by the government, and the tax law of a particular country is a product of the economic and social codes and circumstances of that country. So a multinational must file a tax return in that country that it operates according to the laws and the regulations of that country. And the existence of the two different inherent limitations of taxation as are follows. We, as accounting students, we know that there are inherent limitations in taxation as one of the powers of the state. And there are two, the territoriality of taxation and the international committee. So when we said territoriality of taxation, the Philippine government cannot enforce tax obligations to those subjects outside its territorial jurisdiction, as this would result in encroachment of sovereign or foreign sovereignty. Sorry. That is why we cannot enforce taxes, those export taxes, because the consumption is, especially when the consumption is within the Philippines, we cannot tax the export when the consumption is going to be inside or within the Philippines. Now, for the International Committee, in the UN Convention, countries of the world agreed to one fundamental concept of co-equal sovereignty, wherein all nations are deemed equal with one another, regardless of race, religion, culture, economic condition, or military power. So it is by this principle that each country observes international comity or mutual courtesy or reciprocity between them. Okay. Now, let us look at the tax rates. Corporate tax rates, if you're going to visit this website, this will really give you lots of insight about the corporate tax rates of the global world. Okay. In the Philippines, corporations are subject to 30% tax, corporate tax. Okay. What are taxes on international trade? So we have import duties, export duties, profits of export or import monopolies, the exchange profits, and exchange taxes. Now, Philippines take on international trade the percent of total revenue. If you're going to click this one here, you will see that the Philippines have the average value for that period as of that period 20.85% with a minimum of 16.53% in 1998 and maximum of 29.97% in 1993. So okay, now let's move on the tax minimization strategies. Okay. The desire of multinationals to minimize the taxes they pay worldwide, it's undoubtedly enters into decision making in a significant fashion. So multinationals produce a product in one location and they will sell it in another. And it will really result in in an ability to choose the tax jurisdictions in which they perform various operations. Okay. The different taxes that we have, we can actually minimize it. It's perfectly legal, but tax evasion is illegal. Take note of that. So we have tax minimization strategies in order to minimize the worldwide taxes they have to pay. So some of them, it includes tax credit, this one, tax treaty, tax haven, and international transfer pricing. So when we talk about tax credit, that is a mechanism to mitigate the effects of a worldwide taxation philosophy on multinationals. When tax treaty, it's imposed between nations, and it is established which items of income will and will not be taxed by each local taxing authority that is partly party to that treaty. For example, international agreements that we have, that is one way of minimizing the tax we have to pay. Tax haven, on the other hand, it is used by multinationals to shift income from a high tax country to a low tax country. So tax haven, they are sometimes used by multinationals to shift their income from a high tax country to a low tax country. That's the purpose of tax haven. And then now the last one of methods in minimizing taxes is international transfer pricing. So in this one, this is the final method for reducing worldwide taxes. And this is done through judicious use of transfer prices. When you said transfer price, this is the price charged between organizational units of the same company. Internationally, the transfer prices is a price paid for the transfer of goods and or services between two subsidiaries of the same multinational corporation. So basically, these transfer prices can occur both goods and services. Many multinationals produce a product in one country and then they were going to sell it in a second country, or charge a subsidiary for some type of service the multinational may provide. Thus, the transfer prices occur even if no actual goods cross borders. So example of that, I gave two examples. McDonald's in the United Kingdom pays a transfer price for royalties, and United Parcel Company in Germany pays a transfer price to lease airplanes from United Parcel in the United States. There is a price that is charged for that good and services in the same company. So what's the catch? What's the catch for this one? What's the purpose, or what can we get out from that? It gives multinationals an incentive to shift taxable profit to low tax rate jurisdictions using transfer prices as a mechanism. So this would give us an edge to lower down our taxes. Now, without legalizing it, without evading it, because that is illegal. Now, one of the biggest boons to international business has been economic integration, and it was previously shared the concept about economic integration. And this most notably in the rise of trade agreements, flash on your screen. This reduce or eliminate taxes on traded goods among signatory countries. The ones that I've mentioned, the tax treaty, where we have international agreements, can actually minimize our taxes. So these agreements are either bilateral and trade blocks. So when you said bilateral, this is an agreement between two countries, while trade blocks, there's a group of several countries sharing a single trade agreement. Okay. So these agreements, guys, just wanted to share, many of which began in earlier forms in 1960s. It focused on reduction or total elimination of tariffs, by the way, is these are taxes paid on products crossing the international borders to open up larger markets than any one country could produce by itself. Each country negotiates agreements to trade with other countries in order to maximize its comparative advantage. So, which is a country's practice of capitalizing on exporting its most economically produced goods. Thus, what one country can produce easily and cheaply, it exports those products which are difficult or costly to create. It also imports that. So again, those what one country can produce easily and cheaply, they export. But those products that are difficult or costly to create, they import or it imports. So the reduction of tariffs, it allows both countries have that maximum benefit from such agreement. Example, the United States. Based on my research, the United States currently has trade agreements with 20 countries, and that those countries are Middle East, Canada, Asia Pacific region, to mention few. Okay. Now we need to note some of the trade blocks, and these are the ones I've noted. The Asia Pacific Economic Cooperation, or APEC. The members are Australia, Chile, Hong Kong, Singapore, and the United States. And the Association of Southeast Asian Nations. The members, Indonesia, Malaysia, of course, Philippines, Singapore, and Thailand. And European Union. Among its larger members are France, Germany, Italy, Spain, and United Kingdom. These trade blocs symbolize economic integration by integrating economic exchange among numerous countries within a geographic region or beyond. So although the primary goal is to promote international trade, many of these blocs they also include measures for social, cultural, and political interchange, as well as labor and environmental regulations. Now, for labor laws, still I am your reporter, so stay tuned. Labor laws or